Hello friends, this is Vijay Bhambwani. I've been trading these markets since 1986 and through my videos, I'm trying to help fellow traders understand the markets better. And I hope to help your trading journey evolve better and you could earn better trading profits. Now, of late, markets are rising and you're perplexed about why the sentiments seem to have turned on a dime and how in the end of March, the markets are suddenly so bullish, so cheerful, so buoyant. And is there any particular reason for it? In this video, that's exactly what I'm going to share with you. Those of you who are connected with me for long enough know me that I do not say anything without the solid basis of a foundation, and this video is about that foundation. Now, before I proceed further, two maxims that I want you to understand about the markets ASAP. Number one, nothing happens in financial markets without a reason, and the reason is always financial. So forget about the fact that markets are rising or falling or sideways for a fluke. It's happening because there is a sound reason for it to happen. Number two, WYSIWYG. By WYSIWYG, I mean what you see is what you get is a myth in financial markets. There's always more to it than that meets the eye, and you need to peel layer after layer of maskirovka or deception with the help of analytical data to get to the core of why things are happening and for how long will they continue. So now let's dive into the video of why markets are rising in the month of March. Now, savvy traders, and experience is the main reason why traders get savvy, know that markets undergo cycles. As a matter of fact, I've recorded a video here in which I've explained part of the cycle. Do you know that you could split the market cycles into the year of the decade, the year of half a decade, the month of the year, the quarter of the year, the week of the month, the day of the week, all right, the hour of the day, and you could even split it down to the quarter hour of an hour. Some of it is in this video. Now, similarly, this is a video about why the cycle in the month of March is bullish. Now, part of it is something that I've already shared with you in my earlier videos, my write-ups for the media columns where I write as a guest columnist, that mutual funds are interested in boosting up their net asset values or NAVs, and therefore they boost up prices of stocks that they are holding and they make a substantial difference to their net asset value. Do remember there have been outflows from mutual funds, and if the annual picture is somewhat rosier than what you have seen in the recent past where the markets have been in decline, since end of September 2024, the fresh inflows and assets under management AUMs will depend on how good the report card of the year, the quarter and the half year is. So there is a vested interest here. About vested interest, let me narrate a small story for you. The British and the French were always at competition, stiff competition with each other as to who would dominate the world and who would conquer most new territories. Napoleon wanted to go out on crusades and conquer new lands, and he would ask his generals, "Are you lucky for me if I take you for this conquest?" Some generals would say, "Look, we don't believe in luck, we are warriors." He would tell them to stay back. The others who were eager to please would tell him, "Your Majesty, we've consulted our astrologer and he says your stars and mine align in perfect harmony and therefore I am lucky for you." Napoleon would leave these aside as well. There are some who would tell him, "We don't believe in luck, but we believe in vested interest. You go ahead, conquer a nation and plunder the entire country. Just leave one or two villages for us and we will see to it that we push our men to the point of dying for you in order to win this war." Napoleon would say, "You are the general I am seeking. Please come with me," because the most dependable interest is a vested interest. Now, as a smart trader, if you are to align your trades along with the vested interests of big, powerful traders, you will rarely make some losses. So now you know that mutual funds are interested in the month of March, which is why the markets go up. But is that all? No, there is not. Now, the financial landscape of humanity, of capitalism, of the democratic universe has changed substantially. And the change has been remarkable, it's been astounding, and it has been very, very rapid after the turn of the century. For example, listed equity shares of a company have now become almost quasi capital. It can be monetized, it can be pledged, and money can be raised against it, of course, with a haircut. Now, let me explain to you in somewhat great detail. Now, if your equity shares are listed on an exchange and if the price is 100 rupees per share, if you were to pledge 100 crores worth of your shareholding as a promoter with a bank, the bank could come out and tell you, look, we are going to give you a 30% haircut and lend you money against your shares. Which is, you have shares worth 100 crores, each share quoting at 100 rupees. We are going to give you 70 crores in a loan against your shares. Now, because this is a loan which is secured, it is backed by some amount of collateral, some amount of security as a pledge, interest rates tend to be lower. Now, just in case you're not sure about what interest rates can do to you, do remember what I have been telling you as an online family member who's been associated with me for long enough. Please, please, please do yourself and your family members a favor by understand the cost of fund theory as given by Dick's token. In the description and the pinned comment below this video, I have given you hyperlinks to 3 of Dick's tokens gold standard books which you can read for free. Yes, that's right, for free. So now, if corporates can raise money at lower rates of interest, they would give an arm and a leg to cut their operating costs and increase their profits. That's what capitalism and corporate culture is all about. Now, this is the end of the financial year. Those of you who are not from India, in India the financial year starts on 1st April and ends on 31st March. So the month of March is a time when we balance our books of accounts, where we reverse all the entries that we need to reverse. We basically pay all the outstandings and receive all the outstandings so as to nullify all the entries and shrink the balance sheet size and present a cleaner tax return to the taxman. All right. So now bankers who maintain a haircut on these shares would want adequate cover or adequate security for the loan that they have lent to these corporates. They might look the other way throughout the year or maybe in the middle of a quarter. But come the quarter end, especially the year end, they are very, very finicky about stock prices being above the value at which they have lent money for. For example, if they've lent money at 70% of loan to value with a 30% haircut, when the price was 100, they've given you a 70 crore loan, they would want at least a price of 100. Higher would be better. I'll tell you why. So that when their books are audited, they are on the right side of the law and they are squeaky clean. And the corporate in turn, if has a vested interest in keeping the share prices higher, can go to the bank on 1st of April and say, look, we gave you 100 crores worth of shares and took a 70% loan to value as a loan. Now the price of the share is 150 crores. All right. Can you give us 35 crores more by way of a loan? Remember, it's a secured loan and therefore the interest rate should be lower than an unsecured loan. What do you think the banker would say? All other factors remaining constant, the banker being liquid enough, etc., he would happily advance 35 crore more by way of a loan to this corporate because the share price is up. Remember, Napoleon said the only dependable interest in this world is a vested interest. Now, here you have corporates, here you have mutual fund managers having a vested interest in pushing share prices higher towards the end of March, both for separate reasons. The mutual funds want a healthy NAV and increased inflows by way of SIPs or one-time inflows. The corporates are saying, look, we want to have our LTV or loan to value on a very clean and squeaky clean kind of threshold, and possibly even be able to raise money in the next financial year against a higher share price. Now, why did I tell you at the beginning of this video that the tone, tenor and texture of financial irregularities has changed at the turn of the century? Now, you see, corporate America, and I'm not just talking about India, I'm talking about the universe, the global phenomena as a whole. Now, corporate America decided, hey, the promoters of any given corporation want to take a back seat. They want the company to be run by professionals. And what better way to ensure shareholder justice by way of higher profits and performance-linked motivation than to link the bonuses of the senior management that is running the company as professionals and link it to the profits. You know what happened? So far, you are attuned to thinking that corporates earn 100 rupees but disclose only 50 rupees and take the remaining 50 by way of cash. In India, what we call number 2, do number, black money, under the table, slush money, chai pani, whatever. Okay. Now that is the most simplest explanation of financial fraud. You don't disclose the profits. Another way of financial fraud is you pad up or overstate expenses. So where you've earned 100 rupees and incurred an expense of 30 rupees, your taxable income is 70 rupees. You say, look, that's too much tax to pay on 70 bucks. Why don't we increase our expenses by another 30, 40, 50 rupees? Our tax liability will come down. That is also something that you know. This is too simple. Now, in the year 2000, when Securities and Exchange Commission of the United States of America started looking at why the markets collapsed in Y2K and what was happening out there, they were shocked. Many companies, and I will not name names, you can Google search it, many companies that were being run by professionals with the company promoters and the promoting families taking a back seat, only giving performance related bonuses, were reporting profits that were higher than the actual profits. Yes, they were even paying tax on these non-existent profits. Why? Why were taxes being paid on non-existent profits? So that the profits look more convincing. And why was that? So that the management could claim performance related bonuses. And the stock price could go up. Money could be availed from the banks as secured loans. Of course, with a haircut, LTV, remember, loan to value. Typically, it could be 70%, 60%, 80%, depending on the volatility or the industry that the company operates in. Now, this is why till end of March, you're likely to see stock markets being fairly buoyant. And I'm not saying that come 1st April, markets are going to take a dive like 31st March bullish, 1st April bearish. It doesn't quite work that way. Retail guys who don't know what they are doing will continue to buy, continue to support the markets, and this feeling of buoyancy might just continue for a while. But you, my dear viewer, now know why things happen and for what. Now, financial markets or winning in financial markets is done by us as traders who are brain warriors. We get rewarded for taking risk in the market with our capital for thinking right. Now, the cause and effect theory tells you that if you know the cause, you know the effect, and you know the cause, you also know how long the effect is going to last. which is why I have been writing in my Live Mint column, which is India's first and only mainstream media column that offers you statistical inputs to traders. I have been writing that do not go aggressively short in the end of March, because institutional players are the most active and have the highest vested interest in the markets till 31st March. Remember, nothing happens in the financial markets without a reason, and the reason is always financial. And WYSIWYG, what you see is what you get, is a myth in financial markets. Peel the layer and layer of data that is not shown to you, and you will come to the data that you actually need to see. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know how my videos are helping you become a better trader, and please do share my videos with all your friends, family, and social media accounts to help me to reach out to a wider audience who believes in information and knowledge-based investments and trading. I thank you for your patience in being with me in this video. Till we meet in my next, this is Vijay Bhambwani signing off for now. Have a very, very profitable day ahead. Take care. Bye-bye.